We're going to do a brief video on the stock market, and we're going to compare very briefly technical analysis to algorithmic trading. We've got here on the screen a daily chart for the S&P 500, and we're going to use that to go over a little bit of basic technical analysis. We have three moving averages on here. We have a 5-day, a 20-day in red, and a 200-day in blue. The 5 days in green down here. And let's back up a little bit so we can just talk about this and get a classic little discussion about technical analysis, and then we'll take a look at algorithmically generated trades that RBAM Research puts out every day. So you can see here, this is the 200-day moving average, the blue line, and you can see all the way back here in June of 2020, we clearly broke that line and began a bull market. And a 200-day moving average is a classic indicator for the stock market. It's always a good idea to have it up no matter how you invest or trade, because it gives you a really good idea of the sentiment of the market. As you can see, we got above it. The price respected the 200-day moving average and the red 20-day moving average, and even the green 5-day moving average did not have a lot of twists and turns in it, which is a sign of just steady buying. Also, from a technical analysis perspective, you should always keep an eye on the size of these bars. As you can see, these bars are relatively narrow. This is just straight up buying. People are not even waiting for significant pullbacks, they're just buying. And so this index went from about 3,000 to 35 something, 3580 on just straight buying, which is a really good sign. If you're in the market, you can just stay in the market. All this is for entertainment purposes only, all my opinion, but that's what that would have told me. Now, once you got a breakdown here, you saw this volatility dramatically increase. This bar right here was the beginning of a fairly significant downturn, not a bear market, but a bear move and a bull market. And you could see some indications we kind of a blow off top with increased volatility. But when you saw this huge sell-off, you got a close below the 5-day moving average, and then the next day you had a close below the 20-day moving average. These are all signs that you're going to get, at least in the short term, a sell-off. And of course, that's what we got. Now, you'll notice that we didn't really get too close to the 200-day moving average. We kind of tested it, but we didn't. Got your rally here, sideways distribution. People don't know what's going on, so some people are buying, some people are closing out their trades. They don't think the market's going any higher, and you can see that indicative of a major sell-off without making a new high. So this would have fooled a lot of people. You can see we had the same kind of test, and again, it didn't get close to the 200-day moving average. This would have tipped off a lot of people that, hey, there's strength in this market, people are buying, and this held a higher bottom even though this held a lower top. So this was a kind of a technical buy symbol, again, signal, again, all opinion only, but that's basically a classic buy signal, and that's what happened. You can see they really raced it up, and it went almost parabolic there for a second and fell back down, but did not fall back down to about where you would have expected. It would have been this range here, this 3,400 range. It didn't really sell off bad at all, and it continued to respect the 20-day moving average and continued its trek up. These little tiny dips in this buying are no big deal, especially when you see that the price is fairly well. We're not getting parabolic moves. This is just steady buying. Our volatility increases on the down days, which you would expect. People are kind of panicking, but they start buying right away, and you really don't have more than one significant sell-off through this move. It shows you the market's very strong. This is the benefits of technical analysis. You can take a look and see the sentiment of the market just by looking at charts. Admittedly, you have to have some experience at it, and it's all kind of guesswork, but you get a stomach for it after years of doing it. The market pretty much continued along that path until we once again entered this strong little bear area here at 3,900. Keep in mind, anytime the market gets around major turning points like 2,000, 3,000, 4,000, things are going to change. And you saw that as soon as we got through the 4,000 mark here, the volatility dramatically declined. This is just steady buying. People coming in here just crunching this to buy. Same thing here. We got a little sell-off, a little tiny test. This is really nothing of a test, and steady low volatility buying. You'll see that all the way up until this point here, which is September of 21, way away from the 200-day moving average the whole time. Clearly a nice straight bull market. This was a significant sell-off. You went from down to about 42.69 roughly from 45.50, so not even a 100-point sell-off. In this kind of move, that was almost of a nothing of a sell-off. But you'll notice you had some warning, you had some closes below the 20-day moving average, and if you wanted to lighten up a little bit, you could have done that. Again, no significant test of the 200-day moving average. It never really got that close to it. Same thing happened again. All this technical analysis showing you You have gaps between the 200-day, gap between the 20-day. This is a strong bull market. Now, this is where you started to see some distribution, some serious distribution. If you look at this period from early November of 21 all the way over to, let's call it January of 22, the end of January 22, we basically were oscillating through this point here, this 46.30, and this was distribution. This was the market telling you, hey, we think something's going on, we think this is high, we think this is enough. You'll notice your 20-day went flat through here. Your 200-day did not go flat. It started to go flat here, but all through this period of time, you'll notice this was distribution. And of course, we got our high around here in early January of 22, and you began to see what is now serious bull market sell-off. You had your classic 5-day crossing below your 20-day, confirmation with the price, and then a tremendous sell-off down here all the way back down to about 4,200 from over 48. That's a huge warning sign. This distribution was your warning sign, and this is a huge warning sign that this bear market's over. And in fact, you got dramatic distribution in a huge range from about 42 to 46, 4,500, and right through here with this 4,400 range, everybody's just not sure what's going on, but the smart money's liquidating. Came up, oscillated. You'll notice it oscillated back and forth across the 200-day moving average without conviction on either side, and then finally you saw it roll over and get some serious conviction. Your 5-day crossed over, your 20-day crossed over, and now you have a classic bear market. We're below the 200-day moving average, we're below the 20-day moving average, and you're just in a bear market. This kind of correction is normal even in a bear market, and you see it resume down and put in a bottom here in June. This sideways down here is accumulation. It's also always going to be some people finally capitulating. You have to get capitulation of the sellers before you can get a rally started, usually. Again, all in my opinion. And that's what you saw down here. You saw about a month or so of people trying to figure out, hey, are we done? What's going on? And you start to see the buying pick up. Then you see again the classic buying that we saw earlier, where the volatility is reduced. Look at this volatility here as opposed to through here. And when we did see volatility, we saw it on the upside. So this was a classic indicator that we're above the 20-day moving average, the 5 days above the 20-day, the price is above the 20-day. We're below the 200-day, so we're still officially in a bear market, but we're definitely marching to test, and that's exactly what happened here just last week. We tested the 200-day moving average on this S&P. So all this is predictable to some degree. Again, my opinion, entertainment purposes only, nothing's 100% predictable. But you would expect, let's say, rather, that you would get a test of your 20-day moving average, and that's where we are today. So that's basically technical analysis. That's how you would look at this. There's no real science behind it. You can build trading models and use 5 and 20 moving averages, and if you're good at it, you might make some money. But it's very helpful, in my opinion, to get an idea of what's going on with the market in a fairly just a glance quick way. You can lose a lot of money with a moving average system. You have to know what you're doing, and I'm not recommending one way or the other. Let's go down and take a look now at algorithmic trading. What we've been looking at is classic technical trading with moving averages. RBAM Research puts out every morning before 7 a.m. These algorithmically generated entry prices. So you can set your holding periods up however you want. We've set them up for stocks 1-day, 5-day, and 20-day. You can do longs and shorts on the stocks. This particular output for stocks are longs only or buys only. And as you can see, it gives specific prices. Now, these are all for entertainment purposes only. You definitely have to have your own research, and you should never use these for anything other than entertainment. But if you look at Apple today on the 22nd, it's recommending, again, for entertainment purposes only, a buy at 170 on a 1-day hold. That means basically buy today, close out worst case tomorrow before the close at a loss, or sooner if you take a profit. Same thing with the 5-day, same thing with the 20-day. Buy at 171 and some change today, close out worst case at the end of a 20-day holding period at a loss just before the market closes on the 20th trading day, or take your profits earlier. So that's how these algorithmically generated prices work. Now, the main difference you can see is there's not any subjective guess. Obviously, there's subjectivity that went in and building the models. But the beautiful thing about coming in here and getting these, you can come by every day. They're absolutely free, no credit card required. You can come in and get these algorithmically generated prices and compare them to your own analysis and decide, how it compares to the way you're thinking. Obviously, you always want to use your own analysis. These are for entertainment purposes only, but I think it does help keep you straight in terms of what's going on by looking at what other people are thinking, and especially what other people's algorithmic price outputs look like, because these are absolute prices that you can take a look at as opposed to a range of prices. We cover 190 plus stocks on this. Let me scroll down and show you. You can get them for absolutely free, no credit card required. They come out every morning before 7 a.m. from rbamresearch.com. We also cover the major forex pairs, BTC on the cryptos. We cover the most liquid futures. Everything but the stocks are longs and shorts. The stocks are long onlys for most of these programs that we have. And again, by 7 a.m., rbamresearch.com. Just go there. There's a link in the description. You can sign up. They're absolutely free, no credit card required. That's a brief discussion on the difference between technical analysis and algorithmic trading. I would say to always take a look at both, because they're both helpful, but never rely on anything but your own judgment. If you like this video, please click the like button. If you want to subscribe, please do that. If you have any comments to help us make these videos better, please leave one in the comment section below. Keep in mind, everything you've seen and heard on here is for entertainment purposes only. It's all opinion. You shouldn't rely on any of it for anything other than entertainment, and you definitely trade at your own risk.